Hey everyone, it's Rich Warner from the Smart Investor Models YouTube channel. Glad you could be with me again today. Today I'd like to talk about 3 terms that appear in the glossary of my recent book on bucket investing, which you could pick up, by the way, on Amazon. I'll provide a link for that below. But today I'm going to give you free access to the glossary that appears at the end of the book. And it's a pretty comprehensive glossary with particular focus on bucket investing. So in this video, I'd like to go over 3 terms that appear in this glossary, and they are time horizon, bear markets, and recovery time. Because these concepts are kind of interrelated and they're very important for investors. So let's get into it. But before we do so, if I may ask you to take a brief moment to read the disclaimer statement. Thank you so much. Okay, what exactly is time horizon? It refers to the length of time that an investor holds a particular investment. But basically, time horizon answers the question, when do you need the money? If you happen to have, for example, as most households and individuals do, expenses that are due within a 1 or 2 year horizon, that would be one type of time horizon. That would be a short-term time horizon of 0 to 2 years. That includes all the expenses that are due within that time period. And that is time horizon. In this example, we're going to need the money. We're going to need to tap the account, the savings account, for this particular purpose. Let's call it bucket A, because bucket A deals with short-term obligations and liabilities. So we're going to make withdrawals from bucket A to pay for our expenses that occur during this time frame. Our time horizon for this bucket would be anywhere inside of 1 year to 2 years. But the tricky thing is that, we don't just have expenses and liabilities that are due within 1 or 2 years. Some of them are 2 to 5 years out, 2 to 7 years out. Take, for example, if you're saving up for a car, for a big ticket item, for a house, for a child's education, something like that, you've got an intermediate time horizon there of 2 to 5, 2 to 7 years. Now in bucket investing, we would probably assign a bucket B to that time segment and tailor our investments accordingly. So in this bucket B example, we actually have a few more years to grow our money as opposed to the bucket A time horizon where expenses and bills are due almost immediately. And then we have bucket C, which is for expenses, liabilities, or goals that are pretty far out in the future. Let's call it 7 years and out. And this would be for things like a retirement savings account. Maybe you're going to be retiring in 10, 20, 30, 40 years or less. Or it could be for a child's education due in 18 years or 10 years. It could also be for other big ticket items that you're saving up for. But in this case, we're talking about a time horizon of 7 years and out. And so therefore we have more time, which gives us more time to recover from severe downturns in the market. And that's what I mean by recovery time. The longer the time you have to recover from market spills, the more aggressive you can afford to be. And that's basically the concept of bucket investing. But the important thing when it comes to bucket investing is that you actually sit down and plan out and take a look at your expenses and liabilities and goals and break them down into these time segments of 0 to 2 years, 2 to 7 years, 2 to 5 years, 2 to 7 years, and then anything beyond 7 years. So if you can write them down and quantify them in dollar terms, well, now you've got a plan that you can implement to help meet those goals and assign different investment models based on risk level and composition that are designed to perfectly fit those 3 time frames. I'm going to spend a little bit of time talking about risk levels and how they're related to time horizon. And for this, I'd like to go back in history and discuss what has been the case for stock investors in the US stock market pretty much since the 1920s. So that's about 100 years of history that we have to go on. So for example, if you had invested $100,000 around the top of the stock market bubble in 1929, that was September 1929, within a 3-year period, by 1932, that $100,000 portfolio of stocks would be worth only $15,000. That is a severe bear market, a drawdown of over 85%. Now, it took the average investor, assuming that there were no withdrawals in the interim during and after this crash, it took the average investor about 8 to 10 years to recover their losses. But what if, let's say, you had to make withdrawals during that time period to help pay for expenses and such? Well, obviously you'd be drawing down whatever's left, the residual value of that account, let's say 15,000, let's say it's growing back to 16,000, 17. It's trying to make a comeback, but meanwhile you're making withdrawals to help pay for expenses. Well, then you're going to be cutting into your recovery, and this is going to be very costly. So this brings up the whole concept of making withdrawals at the worst time. The ideal time, of course, to make withdrawals and to liquidate positions from a stock portfolio, of course, is going to be near the market tops. That is, of course, the ideal scenario. But we don't have that kind of foresight to know exactly when the tops and bottoms are going to occur. So let's define exactly what a bear market is. Okay, a bear market is simply a 20% pullback or drawdown in the stock market from the most recent peak. Okay, that's all it is. You know, the market is rallying, and then it sort of hovers and it wavers a little bit, kind of makes a top, and then if it pulls back by 20% or more from that recent peak, that is known as a bear market by definition. But bear markets, as we've seen in history, come in many different shapes and sizes. We've had the severest one occurring during the Great Depression years, 85% plus drawdown. But generally speaking, a bear market of 20% or greater occurs historically every 4 years or so. And another key point that I like to share with you is, Charlie Munger, the co-chairman of the Berkshire Hathaway Fund, along with Warren Buffett, once said quite famously that long-term investors should expect a drawdown of 50% or more at least 3 times per century. That is, at least 3 times in a 100-year period, the U.S. stock market is likely to suffer pullbacks or drawdowns of 50% or greater. So that's very important for investors to keep in mind. The clear message is that you got to have some guts and staying power to ride through these severe downdrafts, which the co-managers of Berkshire obviously did historically. But interestingly, it only took 60 years for Munger and Buffett to experience these 50% drawdowns. It didn't take 100 years as Munger had suggested, but it even occurred in a shorter time frame of 60 years. But Munger is clear to point out that these severe drawdowns, 50% and greater, is just part of the equity investing game. Long-term passive investors have to be ready and prepared for this sort of thing to happen. Now, before we continue, at this point, it really makes a lot of sense to review some of the math here. I once asked a group of students during a presentation, how much does it take to recover from a 50% drawdown? Quickly off the top of their heads, they said 50%. I guess the reasoning being that, you suffered a 50% drawdown, it'll take 50% to make it back, right? Well, that's not actually true. If you do the math, and let's say you start with $100,000, and now your portfolio is worth $50,000, well, do the calculation. New minus old over old. If you're starting with $50,000 as opposed to $100,000, you're going to need $50,000 to make back what you lost, but $50,000 divided by $50,000 is 1.0, otherwise known as 100%. So for a 50% drawdown, you need a 100% return to get back to square one, not 50%. It actually increases exponentially as you work your way down. If you experience a 10% drawdown, you need 11% to get back to square one. If you experience a 25% drawdown, you need about a 33% return to get back to square one. Again, if you have a 50% drawdown, you need 100% to get back to square one. And what if you lose 100% of your portfolio? Well, in that situation, you have no capital to work your way back with, so the actual return is infinite in that situation. But the point is that the deeper the dive or the drawdown, the greater, exponentially speaking, the greater your rebound has to be in percentage terms. And so because you need 100% return to recover from a 50% drawdown, you have to ask yourself, well, how many years is that going to take? Well, if you assume that the stock market can give you 9%, 10% a year on average nominally, well, you're looking at 8 to 10 years of recovery time. So recovery times can take a long time in the stock market if you're 100% invested in stocks. Most investors aren't, thank goodness, 100% invested in stocks. They're invested in portfolios of investment grade bonds, short duration money market instruments, and even commodities to some extent. Some of these, like 85% drawdowns in this case, we're talking about 15 years here, in some cases 20 years of recovery time. That's if you're 100% invested in stocks. And the question then arises, well, who has the luxury of that kind of a time horizon? I mean, if you're talking to a senior, for example, who's 70 plus years old, and they're relying on their retirement nest egg to help supplement their living expenses, to supplement Social Security income and the like, that type of investor doesn't have 20 years necessarily, 15 years to recover from a severe drawdown in the stock market. Time horizon is quite clearly related to the concept of age, because as you get older, your time horizon shortens, and therefore you have less recovery time to recover from these potential disasters in the stock market for those who need to tap their retirement savings to supplement their Social Security income, for example. They have to scale back or ratchet down or downshift their risk level in order to meet everyday living expenses. Now, if you happen to be like Jeff Bezos, Bill Gates, Elon Musk, and the billionaires, these guys have a very long time horizon because anything that happens in the market, they basically have enough assets to cover their back and to pay for their living expenses, etc., many times over. So the whole concept of time horizon really isn't relevant to that type of demographic. Now, if you're 20 years old, 30 years old, 40 years old and such, you still have, 20 years plus till retirement, and you can afford to, floor the pedal a little bit more. And hopefully during this period, you are making regular monthly contributions into your Roth IRA to the tune of about 10%, 15% of your gross monthly income. That's going into your Roth IRA, and you're buying a diversified portfolio, which is going to focus on stocks mainly for your retirement portfolio. That makes total sense. But most investors still have immediate expenses to face. That would be the bucket A expenses that we talked about earlier. If you're doing this right, you should also have a bucket B to help complement bucket A and bucket C. Bucket B acts like a bridge where you can sort of, transfer money from and into bucket C into bucket B into bucket C, bucket B into bucket A to help cover and get yourself realigned. But the amount of money that you have in each bucket is really a function of where and when you need the money by. So if you have a lot of short-term expenses and debts to pay off, you're going to be focusing on bucket A. Meanwhile, hopefully you are injecting monthly a percentage of your income into the long-term qualified retirement account and then letting the compound growth do its magic over time. Once again, that bucket C is way out there in the time horizon, so you can afford to really floor the pedal with stocks to the tune of 70% allocation to stocks, or even more in some cases. Part of this discussion, I'll include the PDF that I drew up to help organize my thoughts here, and I include a table that breaks down the percentage allocation, the weighting to equities inside various models, the bucket A models. I've got 3 of those, bucket B, bucket C. As you would expect, as you go out in time, your equity allocation increases. But as you increase your equity exposure, you increase your risk levels, your risk exposure. And because of that extended recovery time for volatile assets like stocks, you therefore have to assign longer time horizons to those strategies and to those buckets. So here we have this concept, this wheel of related concepts, if you will, where equity allocation level is directly related to risk level, is directly related to recovery time, which then dictates time horizon, which then dictates the composition of the portfolio. So in this video, we defined what time horizon is, we've defined what a bear market is, and because of bear markets, we can appreciate the concept of recovery time. So I'd like to just briefly summarize some of the key points or takeaways from this discussion. First off, bear markets are real. They occur on average every 4 years or so. And some of these bear markets can be quite severe, as Charlie Munger pointed out. We can expect drawdowns in excess of 50% at least 3 times per century. We also clearly pointed out that higher equity allocations require longer recovery times. So a bucket C type model is going to need more years to recover than, say, a bucket B, which will require more years than bucket A. And incidentally, bucket B is like a moderate portfolio with very little allocation to stocks, if at all. And in a bucket B strategy, for example, you can substitute equity allocation, stock ETFs, with high yield bond portfolio, for example, and a little bit more aggressive income strategies, which are much less volatile than stocks and provide a good bit more yield and income than the bucket A strategies. But the moderate growth, you're looking at about 2.5% more total returns per year, with a lot less risk than what is assumed for bucket C type models. I may end up doing a few videos on this whole concept of bucket B investing in the future as well. In terms of recovery time for bucket B models, moderate growth, essentially fixed income with a little bit of kick, they do experience negative down years, but nothing like equity models. They will recover usually within 1 year, 2 years at most. You can recover your losses from a moderate growth bucket B type of asset allocation. So that's a much shorter recovery time than, say, a bucket C model, which can take as long as 8-10 years. In the bucket B case, we're only looking at 1 to 2 years. So this is why bucket B models fit nicely inside that 2 to 5 year time horizon because of their faster recovery times. As far as bucket A models are concerned, this is the ultra-safe, conservative, money market-like instruments, the short-term, ultra-short-term bond ETFs, etc. They have never shown a negative year or down year. And so the whole idea of recovery time is not even relevant in the case of bucket A. And this is why these type of models that are so conservative and safe make a ton of sense for those who have a lot of debts to pay off and bills and utilities and living expenses that are immediate and within a 0 to 2 year time frame. These type of models are excellent for parking your cash and generating a decent enough yield to beat inflation and the rates on CDs, for example. The problem that you face with short-term safe strategies is that inflation is always the party pooper. It's going to cut into those returns significantly. And so bucket A strategies have little to do with long-term wealth building. They're essentially for you to pay off your debts and liabilities. That's what bucket A strategies are all about. If you want to build wealth for the long haul, like Warren Buffett does, you got to have some equities, but there's pain involved. There are these 50% drawdowns that you have to go through. That doesn't necessarily mean you have to put everything into your bucket C to become wealthy. As mentioned, you could just plunk down a percentage of your gross income every month into the qualified account and let compounding and the rebounding nature of stock markets over long periods of time work their magic, and over time you will build significant wealth. That is a fact. That is true. And it's similar to the faith that a lot of American investors have towards real estate. But if you do the math and you calculate all the expenses involved with real estate and everything, there is no better way to build wealth than with stocks over the long haul. Another key takeaway that we covered is that recovery time becomes an increasingly important and significant matter as you get older. So seniors especially have to be very conscious of the recovery times that volatile investment asset classes require. And it's not just an age thing, it's also because these seniors are relying on their retirement portfolios to supplement their Social Security income in many cases. And by doing so, they're actually drawing down that retirement portfolio to the tune of 4, 5, 6, and even 7, 8% per year. And the risk of depletion is a significant issue. But does that necessarily mean that because you're drawing 6, 7% from your retirement account every year to pay for living expenses and supplement Social Security, does that mean you have to floor the pedal with those assets to make more money in the stock market? The answer is no. Because if you do that and you experience a 50% drawdown, well, now you sort of pushed off the amount of wealth into the future because it could take as long as a decade to make that money back. And if you're continuing to make those higher withdrawals along the way, you're never going to recover. And so what I would propose in such a situation would be to avoid heavy exposure to stocks for those seniors and to do their best to live frugally, to budget their expenses, to be very conscious of their cash flows, and to try to stay as healthy as possible, to cut back on medical expenses, and perhaps even to try to generate a side income during retirement. That would help to bolster so that they can make contributions into, let's say, a bucket B type of asset allocation. Young investors, on the other hand, have the luxury of time. They have decades until retirement, and they're also in accumulation mode. The only problem that young investors face typically is heavy debt load, to pay off for their student loans, what have you, cars, whatever, and even a home as they get a little older. So if you're in that type of situation, you have the luxury of time, so you should be socking away 10-15% into your retirement portfolio, and that bucket C retirement portfolio is going to be flooring the pedal to the tune of 60-70% allocation to stocks. Nice thing going on there. But on the other hand, you have these bucket A responsibilities, these imminent expenses and bills and debts that you have to face. So essentially what you have when you're younger is you have this barbell concept developing. You need to pay off your debts, priority numero uno. So, bucket A models, very safe, very conservative. The money's got to be there to pay those bills. Okay, that's your bucket A. So you're going to be allocating a lot of money there to pay off those bills as best as you can. Meanwhile, you got this bucket C long-term portfolio. So you have this barbell effect going, simultaneously. That's when you're younger. Now, as you get into your mid-career period, then what you have going is a bucket B scenario developing. Now, the bucket B is very useful because it can supplement the income from bucket A. You get a little more yield and income from a little bit riskier bond portfolio with maybe a little bit of equity exposure there. Bucket B serves as a bridge between bucket C and bucket A. When you get older, you start drawing down your risk levels and your glide path becomes more conservative. Money's going to flow from bucket C into bucket B. So bucket B kind of acts as this bridge, this intermediary for the flows across the three buckets. And the other key thing about bucket B that you got to keep in mind is that it's a perfect medium for TLH, which is tax loss harvesting. If you don't know much about tax loss harvesting, you should check out my 2 or 3 videos. I actually built an app called the Wash Sale Guard app, which tracks your harvesting of tax losses, which you can only do in a taxable account, by the way. You cannot take losses inside of a retirement account and hope to use those losses as a means to offset future capital gains like you can inside of a taxable bucket B type of account, where TLH becomes essential and can save you a lot of money in future capital gains realized. And so do check out those 2 or 3 videos that I made on the subject of tax loss harvesting. So bucket B, as you get older, mid-career types, you're slowly paying off your mortgage and you're getting rid of all your debts and everything. And now is the time to sort of add that bucket B in. In your younger days, you were focusing on, the barbell effect between bucket A and bucket C. You got that going. But then as you get older and you wind down the debt burden, now's the time to start building up that bucket B as a very helpful intermediary between the other two buckets. Now, these are concepts that I talk about in my bucket investing book. If you'd like to check it out, there's a link below this video. But do pick up and download the PDF to this video and also the free glossary. That's the last chapter in the bucket investment book. I'm giving that away for free. So click on that. And also let me know what your comments are. Your questions, suggestions, feedback is very important to me. So in my next video, I'm going to be talking about two terminologies from the glossary chapter that many investors tend to confuse. It would be helpful to clarify them for you. So do stay tuned for that one. This is Rich Warner again from the Smart Investor Models YouTube channel, and I look forward to seeing you in the next video.